Hello and good morning, everyone. This is Paul Sanfilippo from Penny Insurance. Welcome to part 3 of our 5-part series on Grow Your Business with IUL. Today's part, we're going to focus on a little bit of a recap of last week, looking at some of the way the index are credited inside the accounts, look at some of the interest loan options that are in there, and then dig deeper into some of the features and benefits that are associated with permanent products, specifically around the accelerated benefit rider and the long-term care rider. So today should get you pretty close to understanding, the IUL chassis with North American. Today's speaker with us today is Chris Korfe from North American, and we're going to turn it over to Chris and let him start the presentation today.
Okay, and just want to thank you, Paul, and once again thank everyone for taking the time to be on today's webinar. This is part number 3 in our 5-part series of our Demystifying IUL. Today I'm going to be covering some compelling product features that are in our IUL product. So we'll go through it, and then after that we'll take some questions at the end. So of course our disclosure compliance likes to have their say. So today, our agenda is going to be, we're going to talk about the different index selections that we offer here at North American. We're going to talk about daily sweeps, that we do not require any money to be into the fixed account if you do not want any money to be in there. Our interest rate crediting on beginning year values, our interest rate bonus, our standard and variable loan rates, over loan and protected death benefit riders, and then probably our most popular feature that we have on all of our ULs and IULs is our chronic illness accelerated benefits. So on our index selections, we have 13, and that's on the Builder and Guarantee Builder. We have 7 on the Rapid Builder. So you can see on the annual point-to-point what we have there, we use the S&P, the uncapped S&P, Dow Jones, NASDAQ, mid-cap on the S&P, Russell 2000, Euro stocks, and then we have a multi-index group, and then within those we do offer some daily averaging and then some monthly point-to-point. So basically, from what this means to you and your clients is the fact that you can really diversify within the product itself. You're not just locked into one index that's, if it's just the S&P, well, what happens if we come into a year where the S&P has grown and grown and grown and we think it's going to go down, where maybe the Dow Jones was flat and we think that's going to rise? Well, some products that may not offer that, you're just kind of stuck, whereas here you can move it out of one bucket into another. So, that really makes it nice for your clients to be able to have that type of flexibility within the product itself. So on the daily sweeps, funds are allocated to the index segment the next available trading day. So this is for any new premium payments, any 1035 exchanges, any transfers from the fixed account. Funds do not need to sit in a fixed interest holding account until the next sweep period. What does that mean, you're saying? Well, if you have a client that, say, makes their payments they're paying monthly, and maybe they make their payment on the 2nd of the month. Some companies may only sweep on the 15th of the month. Some may sweep at the end of the month. Well, then they're just sitting in an interest-bearing account, and the whole reason for an indexed account is to take advantage of the index gains. That's why we're not purchasing a traditional UL. So your money for half a month, almost a full month, is just sitting there really not working how your client wants it working for you. Whereas if the money goes in on the 2nd, and that's a Wednesday, we'll sweep it on the 3rd, which is a Thursday. So we do it on a trading day. Some companies require that a certain percentage of your funds go into a fixed account for cost of insurance, things of that nature. We do not require any of that. So with the daily sweeps and the fixed account, not requiring any money there, that's really nice. Now, if you do have somebody in the fixed account, you can transfer it on a daily basis, whenever you want to, into the indexed account as well. So as I said there, no requirement of allocation of fixed account. 100% can be credited to the indexed account, which is, like I said, has all your money doing what you want, what your client wants it to be doing. So interest is credited on the beginning of the year segment value, regardless of cost of insurance charges taken throughout the year. So we're going to credit it before we take out the charges. So obviously, I mean, it's pretty simple to understand that if you're putting your clients, say, putting in $1,000 worth of premium and the cost of insurance are $200, instead of only crediting it based on $800, we're doing it based on $1,000. Just again, more of the client's dollars working for them in this product. So our interest rate bonuses, these are contractual if they are in the indexed account. On our builder IUL and our guaranteed builder, it's 0.75% years 11 plus. So what that means is if we have a down year in the market where the return would be a 0, if it's year 11 plus, your client is still going to show a 0.75% return. So it makes it very nice to know that when you're having your annual review, even in a down market, you're going to be able to show your client a positive gain. The Rapid Builder, just how that product is built, it's not quite as generous of an interest rate bonus, and it happens in year 16. Our survivorship, it's 0.5%, 11 through 20, and then it kicks up to the 0.75 years 21 plus. As I said, it is contractually guaranteed on an indexed account. It is conditionally guaranteed on the fixed account. So, but generally speaking, if you're in an indexed product, you're going to be in an indice. On some of our ULs, that bonus is on just the straight ULs on the fixed account. Like I said, it is conditional. It's applied after the cap, floor and par rate. So like I said, if it's a 0%, you're going to get the 0.75. On the builder right now, let's say you're in the annual point-to-point, and it's 13.5% cap, we would put the 0.75 on after the cap. So it would be 14.25. So just another real nice feature of our products, that really have the client in mind, just to help them. Like I said, it's so nice to see that you're getting something from the money. These guys, these clients are working hard out there, putting the money into these policies. They like to see a positive return. You never like to come back and say, hey, you put all this money into it and we didn't get anything this year. So at least it's showing them something. So standard loans, that's a loan rate set by us here at North American, subject to guarantees. The current loan interest rate is 4.25 minus interest credit rate of 3% equals a net cost of 1.25% years 1 through 5. So if for any reason someone needed to take a loan out in years 1 through 5, it is going to cost them 1.25%. Net cost zero loans starting in year 6. Basically we're just going to credit you interest, what we charge you for interest on the loan. And our account value backing a loan values must be allocated in the fixed account. So if you're using these type of loans, it's got to be in the fixed account there. So this is the one that we normally talk about when we are talking about our index UL portfolios or variable interest rate loans. It is adjusted with the Moody's corporate bond yield as published by the Moody's Investor Service. And current variable loan interest rate can change on the policy anniversary. So if it's say 4% when you start, it's going to remain that through the year. But at the end of the year, it can change just based on how things are moving. So the account value backing loan values remain in the indexed account and receives quote-unquote normal interest rate crediting. The floor is 4. It's capped at 6 for the builder, Rapid Builder, and Guaranteed Builder, and that is priced into the product. I just like to take a little moment here when we talk about this, the difference of variable loan rates and how we illustrate. At North American, we have a max rate. If you run our illustration, the max illustrated rate is 8.2%. We come up with that by using our S&P annual point-to-point of 13.5, geometrically back-tested for the last 30 years. We get an average of 8.2%. We do the same thing for our variable loan rate. So even though right now, if someone was to take a loan out, it's going to be 4, we illustrate 5.8% because we back-tested that 30 years. You're saying to yourself, big deal, Chris, why are you telling me this? Well, some companies are using current variable loan rates when they're running illustrations and you're taking loans out, but they may not have a cap, or it may be 8-10% on the variable loan. So if we're running an illustration showing a loan, retirement income supplement or whatever scenario we're running, where we're showing loans coming out, and if in 20, 25 years, if that other company is illustrating 4%, we're illustrating 5.8 with a cap at 6. Let's say that 25 years from now, when they start taking loans, interest rates are at 7 or 8%. Well, that's going to make a big difference from what the client saw in that illustration to what they're actually going to receive in a loan because of the higher interest rate. Whereas in North American, if it's 7 or 8%, most we're going to charge is 6. That's 20 bips more than we showed on the illustration. So just having that built-in cap, I think, is huge when you're talking about loans. You can participate if loan rates are low. I mean, the floor is 4. I mean, are we really going to see it ever go much lower than that? You could, but I mean, I don't think too many people are going to be upset about paying 4% on the loan. And capped at 6, when that's not very, that's a really nice feature to have to just give your client. They're going to feel very safe knowing that hey, if everything goes crazy and interest rates go through the roof, the max I'm going to get charged on my loan is 6%, and that really helps with showing positive arbitrage as well. So I always like to talk about this when I talk about our variable loan rate as compared to other carriers. So standard and variable loan interest rate loans, one loan type allowed at a time. So that's pretty self-explanatory. The nice thing is you can switch between loan types at any time. So there's no cash payoff required. Remaining balance just transfers to the new loan. So if you were in the fixed and now you want to go to the variable because it's low, you can do that. So we do allow that, and that's just a real nice feature. Once again, just allowing your clients that flexibility to be able to do that with their policies. We have our overloan protection benefit is built in right into the product. Exercising guarantee, basically it's saying that we're not going to lapse the policy. It's available on any policies that have been enforced at least 15 years and the insured is greater or equal to age 65, withdrawals of all basis, and the policy debt is less than the overloan election amount. So really what happens there is the overloan election amount, either that's kind of the numbers we look at if they're going to take a loan. You have to have 89% of the account value, ages 65 through 74, or if it gets below 93%, age 75 plus. Just basically what we're saying is if, the reason that individuals use life insurance to take loans out is the taxable, the favorable taxation on it, tax-free loans. If you end up mecking it, now you're on the hook for all those premiums, and it creates a nasty tax situation. So what we're going to do is we're not going to allow you to do that. If you put in for a loan and we run the calculation and it shows that, hey, you're age 75 and that's going to get you to 94%, we're going to, let you know, hey, we're not going to let you do that because we don't want to create a unfavorable tax situation for you. So that's just nice to know that we're not going to allow clients to do that. Our protective death benefit feature, this is a real nice benefit that I don't think gets talked and or utilized enough that we have. Basically, what this particular benefit will do is, let's say you have an individual who's 40, takes out this policy. Now that at age 65 they want to start taking their some loans out. Okay. Basically, what we're going to allow them to do is to use the cash value they've built up to then purchase a paid-up policy. So let's say they have, just to throw some numbers out there, let's say they have a $500,000 in cash in their policy, and they have 2 children. They want to be sure that there's at least $100,000 per child to be left to them at the time of their passing. So they give us a call and they say, I want to pay up for $200,000 of death benefit. So we do the calculation, take the money out of the cash value, buy up the $200,000. Now you can take loans out on the rest of the money. If you take all the cash out, that's fine because you've paid up for a policy. So what we like to say is, if people ask if our builder IUL is a guaranteed product, we say yes, no, and yes, because on the builder, if you just pay the minimum premiums during the life of the policy, it's guaranteed for a minimum of 20 years. So if someone just paid the minimum premiums every year for 20 years, they would have that death benefit. Most people obviously wouldn't do that. So if you're paying how you normally would, now at age 65 or older, and you've had it for at least 15 years, you can now purchase some paid-up death benefit, which then once again guarantees it. So you can see how it is guaranteed, then it's not, then it can be. And like I said, that's just a feature that I don't think gets talked about enough. We're working hard to really market it here at North American, because it is a great feature. You get a product that you can really get a lot of cash value built up in, and then buy some death benefit and then take the loans out. In all of our ULs and IULs, we have our chronic illness accelerated benefits. So the chronic illness accelerated benefit, we call it our CABR. It's on the actually that's just on the builder product, and then the accelerated death benefit endorsement is on the builder survivorship, guaranteed builder, and our custom guarantee. Basically, what the difference is, there's not the chronic on the rapid builder. But the main one that, or critical, I'm sorry, on the rapid builder. But the main one that everyone likes to talk about is the chronic portion of it. It is on all the products. There is no additional premium for it, no additional underwriting. It is automatic at issue. Basically, as long as the person is table 4, they will get it, or on the survivorship, the rating, combined rating of 8, they will get it. And it's, like I said, the chronic portion is the one that most people like to focus on. That's if you're permanently unable to form 2 of 6 ADLs or have severe cognitive impairment requiring substantial supervision, and you can see the 6 ADLs there. The physician certification within 24 or 12 months of it has a 90-day elimination period, and there's just a form you have to complete. So basically, if someone has a situation where they're unable to perform 2 of 6 ADLs, and let's just say that the 2 are toileting and transferring, and let's just say it's a husband and wife, and let's say it's the husband that has the 2 of 6 ADLs, and the family says, well, we can probably take care of it. After 6 months, they're like, we just can't do this anymore. They get the physician certification that helped happen 6 months ago. That takes care of the 90-day elimination period. They complete the form, they can have the money right away. So that's how that kind of works with the elimination period. And how it works is you get 1 election every 12 months. The maximum per election is the lesser of 24% of the death benefit, or $240,000. So what we're saying there is you can accelerate 24% of your death benefit, but if your death benefit is over $1 million, the max we're going to let you do is $240,000. And you must maintain a residual death benefit, which is the greater of 5% of the death benefit, or $10,000. So depending on the size of your death benefit that final year, you may not be able to do a full 24% of that death benefit. So there is a $200 administration fee per election. The death benefit the policy receives is reduced by the amount of the death benefit accelerated, and lapse checking is suspended during the election and when over 50% of the death benefit has been accelerated. So basically what we're saying, since it's 2 of 6, unable to permanently perform 2 of 6 ADLs, if you use the benefit, we're going to basically suspend, lapse checking is suspended, meaning we're not going to lapse your policy. Once you take that 3rd year, where now the death benefit is over 50%, if you're doing the full 24, we're not going to lapse your policy. So, in theory, we're not going to lapse your policy once you start doing this because of how we have it set up. A lot of times we get asked, so if we're accelerating 24%, let's just use the $1 million there, and $240,000 is coming off the death benefit. How much is my client going to receive? They're not going to receive the full $240,000. Basically, what we do here at North American, since we're putting this benefit on, basically, in reality, free of charge in the front end, we need to recoup those costs on the back end. How do we do that? Couple things. Basically, we look at what is the current interest rate environment right now. So instead of giving the client this money early, what could we have made in, had we invested the money ourselves? So obviously, in a lower interest rate environment, the client's going to get more money. If it's higher, they're going to get less. We also look at age. So the older they are, the more the benefits they're going to get, and sex. Males will get more than females. And on our software, under the Riders tab, there's a portion down the bottom that says Changing Needs Report. You can put in different ages. It defaults to 65. I usually do that and then put in 70, 75, and 80. You can run the Changing Needs Report, and it would show you, based on that death benefit, how much there would be there for these particular riders, how much they could get out. Now, obviously, it's not contractual. We show a 4% interest rate and an 8.3. If it's lower or if it's somewhere in between, but that just gives the client a really good idea of how much money they could expect to get after the death benefit's been reduced. And basically, if they want to do that, they can call up. We can run the calculation for them. If the client looks at it, let's say they have a policy with a lot of cash in it, and maybe they're younger. They could say, well, if I'm giving up $100,000 a death benefit and only getting $50,000 in cash, that just doesn't sound like a good deal to me. Why don't I just take some cash of the policy? You can definitely do that. We just run the calculation, say this, if you take this benefit, this is what you would get, and then you can do with it what you want at that time. So that was the presentation of our compelling features that we have in our products that we think really separates us from the other carriers. Here's my contact information here at the bottom. My email address there is ckorfe@sfgmembers.com. My extension is 36326. Same 800 number that's up top there. We are Central Standard Time, and we do close early on Fridays. And, of course, you can always give guys over at Penny a call as well. And with that, I would welcome any questions that may be out there.
All right, great. Thanks, Chris. It doesn't look like there's any questions at this time. We do appreciate you guys taking the time to come to our call today, and we look forward to seeing all of you again next week.